Hello, and welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Fran Beyers, Managing Director and Head of Capital Markets at Cliffwater. Fran, thank you so much for joining us here today.
Thank you so much for having me.
This is our third podcast. We've done other things, but this is actually number 3. I can't believe time has flown by. The industry for private credit, because Cliffwater does private credit, has just grown so dramatically. It's about $1.5 trillion. Street estimates have it growing towards $3 trillion by 28. And your firm has grown along with the industry. Why don't you give us a little bit of a fresh update of where Cliffwater is today?
Yeah, no, thank you. And the growth has been tremendous, and we've been a huge beneficiary of that. So Cliffwater launched its asset management business back in 2019 with our inaugural fund, Cliffwater Corporate Lending Fund. That fund was basically designed to invest in the direct lending market, as you signaled. It's a $1.5 trillion market, so it's a very large market opportunity. Today, that fund is around $40 billion in gross assets.
That's amazing.
$30 billion in net. It is now the largest interval fund in the world, and Cliffwater itself is the largest interval fund manager in the world. We are very dedicated to this structure, and we're very dedicated to the high net worth and RIA channel. So after we launched CCLFX, or Cliffwater Corporate Lending Fund, 2 years after that, we launched our Enhanced Lending Fund, which is also a credit-focused fund, but it operates in the areas of private credit outside of direct lending. So it's focused on more of the esoteric parts of private credit, like mezz lending, legal assets, royalty finance. And then just in the last 2 years, we launched our third interval fund, which is Cascade Private Capital Fund. That is a private equity-backed fund. And so together, all 3 of these funds are around $50 billion. We're continuing to grow. We're expanding into new offices, new locations. And so it's been really, really exciting. And alternatives is booming.
Well, congratulations. And you just opened up your 4th office?
Yes.
Out in California, if I remember correctly?
We now have 2 offices in California, in Marina Del Rey, Newport Beach. We might be potentially opening an additional office somewhere in the U.S. coming in a theater near you. And we're at over almost 200 people now at Cliffwater, so we're even outgrowing our New York office. So we might be moving for a 3rd time to another office in New York just because we're just expanding so rapidly. We've been really committed to reinvesting in our growth across legal, operations, marketing, investments. We're just continuing to add people. So it's been really, really exciting.
Well, congratulations on the
Thank
great
you.
success. The last time we spoke, we talked about returns, right? Everybody wants to talk returns. And there was a time you could get double-digit returns in the lending space. But that's kind of shrunk a little bit. And of course, interest rates have been coming down. Why don't you talk about the return structure where we stand today?
Yeah. So in like the last year or 2, you're starting to see articles come out. Oh, is the golden age of private credit ending? Returns are coming down. The market's really competitive. But candidly, earning 12% yields on first lien debt was very unsustainable for a long period of time. Those are equity-like returns. And so the asset class was going through a Shangri-La couple of years where base rates peaked at 5.5%. And then we saw spreads at an all-time record high in like the 650 basis point area. And we were able to lend to like massive companies when the institutional and high yield bond market was shut for a period of time. So direct lending was throwing off incredible yields 2-3 years ago. Then the markets opened back up. Rates started to come down, market conditions became more competitive. So now we're back in that 9.5% area for first lien debt. That's still really attractive.
It's not a bad return.
No, it's still really good because if you look at, now direct lending's been around for 20 years. This is not a new asset class. It's obviously been getting a lot more headlines in the last 5 years, but it's been around for 20 years. Typically, first lien loans on direct lending has been like 6 to 7%. That's the long-term average for first lien yields. So you're still getting 250 basis points of additional return on first lien assets today. So we still think 9.5% is really good. Now, are there going to be additional base rate cuts coming? It feels like that's happening. The Fed has signaled that, we're probably going to see a couple of additional cuts. So long term, the asset class feels like it is going to start moving back more towards its longer term average. But we still think that direct lending funds should be able to deliver a high single-digit return for the foreseeable future.
So what's the long-term average return?
So direct lending is, long-term in that 9 to 10% ROE
average
area. Obviously, direct lenders are using leverage. CCLFX only uses a quarter turn of leverage, but we also charge very low fees. So we're able to, right now we're generating around a 9.5% return on our fund today. But when we launched the fund, it was more like 7% because base rates were near zero. So you tend to see the bare minimum is around 7%. If base rates went to zero, we don't expect base rates to go back to zero. People are talking about 3% long term. So we still think high single digits probably pretty reasonable long term.
So talk about the wealth channel. That's been a big growth area. And you said you do service the wealth management channel. With rates coming down, are they still interested? Do you still see it to be a growing market for you?
Oh, yeah, 100%. So the wealth channel is the biggest opportunity in private credit and in alternatives right now. So if I take you back through time in the history of direct lending, really it started to become popular coming out of the great financial crisis in 2010, 2011, when direct lenders just started pitching pension funds and institutional investors who had a really rough go coming out of the GFC and just weren't getting the yields that they wanted in their bond portfolio and their public investments. And direct lenders would say, this is a really great asset class for you. You're getting high single digits, it's not volatile. So after the GFC, all the way up to 2019, 2020, the market grew to $1 trillion. And that was on the back of institutional investors, big pension funds making allocations to private debt in a big way. Fast forward to the last 5 years, that market's becoming a little bit more saturated, institutional. Some of these pension funds have denominator issues, or they have just they're already allocated to private debt. They might have 10, 15, 20% of their portfolio already allocated to it. So now the future is wealth, where a lot of RIA clients, high net worth individuals are very heavy 60-40 portfolios. They're where institutional clients were a decade ago. And so there's a lot of white space and growth for them to just move a small portion of their fixed income or their equities portfolio into alternatives. And so that market, the high net worth market, the RIA market, is trillions of dollars. I mean, you would know better than me. I think we estimate the RIA market alone is like $7 to $8 trillion. So there's a lot of white space. And so you're seeing all the direct lenders and private credit managers coming to market trying to launch products that are designed for wealth. And so what is it that the wealth channel wants? They want evergreen funds that are fully invested on day one. They want to come in and get immediate deployment and immediate dividend return versus back in the day, institutional investors were okay with drawdown funds. They want ease of use. CCLFX, Self, Cascade, all three of them are ticker execution. You can put money into it every single day. No paperwork, no investor requirements. And
similar to a mutual fund, right?
It's exactly like a mutual fund. And you can come into the fund every day. The big difference is that we only offer liquidity a couple times a year. So for CCLFX and Self, the two private credit interval funds, we offer quarterly liquidity. And Cascade, because it's more private equity, we offer semi-annually. So for investors that are willing to give up just a little bit of liquidity, and they're not necessarily needing all that cash on hand, this is a great investment for them. And we're going to see wealth. The wealth is what's going to bring it from $1.5 trillion to $3 trillion over the next 5 years.
So let's talk about the economy. Do you take a look at the economy, try to figure out, is it growing? How is it going to impact the lending market? You talked a little bit, maybe the Fed will be cutting rates. How do you factor all this into your analysis? What are you looking for from the economy?
I think we're all trying to figure out the economy. It's like the best question that I love asking people, where do you think we are? Because the data is very mixed. Now you don't even know if you can believe the data. But we're very, very focused on the economy. With regards to rates, I think rates coming down and the view that we're probably going to see additional rate cuts does signal that there could be a little bit of softness. The job numbers have come back mixed, but then there's been reports that are coming out that consumers are still spending and that tariffs aren't impacting them too dramatically. So listen, I'm always worried about credit. I've been worried about credit for 3 years, and everyone always tells me, Fran, you're worrying too much because the economy's humming and it's doing fine. And I will tell you, we have in CCLFX over 1,000 borrowers in our portfolio. Now, credit is a little bit of a lagging indicator because by the time we get financials, some time has passed. So we can only give you information on performance through like June 30. So it is a little bit of a lagging indicator, but we are continuing to see like high single digit revenue growth, EBITDA growth in our portfolio. And one of the things that we look at in terms of distress in the market, because there's been a lot of stories on, oh, the default rate's climbing and there's distress and private credit, we can look at barometers of health. We can look at, what percentage of the loans are marked below 90 cents on the dollar, because these loans should be trading around par. If they're distressed, typically we say 90 cents on the dollar is the barometer. That's only about 5% of the market today is trading below 90.
So it's not a large percentage.
It's not a large percent. And if I go back 2 years, it was 7.5%. So it's actually improved with base rates coming down and spreads coming down. And then we look at watch lists. So we have something called the Cliffwater Direct Lending Index. We created in 2016. It tracks the entire direct lending market. And good, bad, there's really no way for you to hide losses and to hide issues in that index because it's all public information. And what I will tell you is that we look at the tail of the portfolios within the index. It's around 8 to 10% of portfolios has a tail to it where we see it's on the watch list. That number, 8 to 10%, has been stable for the last 3 years. So we're not seeing a degradation from where we were since 2023. The economy is kind of humming along.
So tariffs, that's kind of telling me that you're not seeing an impact from tariffs, or at least not yet.
I think that's the key point is how severe will the tariffs be, and not yet. Because here's the thing with direct lending. We don't lend to every sector. We very much focus on more asset-light, defensive industries like software, services, healthcare, financial services, where it's higher margin, higher variable cost structures, not a lot of heavy. It's not going to have a lot of heavy tariff exposure. It's going to have some second order and third order tariff exposure, but it's not going to be heavy. And so we're not really seeing too much tariff pressure in those sectors. Those sectors drive 75% of direct lending. There are some sectors where you are starting to see tariff risk surface. I would say off the top of my head, the most prominent one is autos. There's been a couple of high profile bankruptcies in the last couple of months, auto related, where they've come out and they've said tariffs have really hit us hard. There's been consumer companies, distributor companies that have very thin margins are going to have a lot bigger issues if they're buying goods.
They don't have wiggle room.
They don't have wiggle room, and they have to buy goods. They're going to get hit with those tariffs, and they have to try and sell those goods to their end markets, which might be pushing back on price. So companies that are lower margin, that are touching the movement of goods and services, particularly abroad, autos, right? Auto suppliers is where you're seeing a huge impact because they're buying tons of SKUs that are getting impacted. So those types of sectors are going to have issues. But I think within direct lending portfolios, they're kind of in that tail.
But they're selective, and it's not broad-based. But when you hear this on the news, it can be, or read it in the news, it can be very, very upsetting.
Yeah.
But it's not broad-based, so that's great news. So you've gone into the private equity market. So basically, Cliffwater was a private credit. You grew private credit. Now you're step-toeing into the private equity. I think I got that right.
Yeah.
Into private equity. Talk to me about that. Like, what is the product? What's in the product?
Yeah.
I'd like to learn a little bit more about it.
So Cliffwater, before we launched our asset management business, was an advisory firm on alternatives. And private equity was probably our first asset class that we were going out and selling to our big institutional clients. It's actually our biggest asset class on the advisory side. It generates like 40 or 50% of the funds that we're advising on our clients. So we've been very familiar with private equity. We've shown through all our research through the years that private equity delivers a really nice return premium over public markets with less volatility because you have very reputable sponsors coming in, executing on operational improvements to improve these borrowers. So we've always been big believers in private equity. But of course, we love debt. So we started with debt. The private equity interval fund Cascade is actually really such an amazing product for retail and for wealth because accessing private equity is even harder for an individual investor to get access to versus credit. Before, you could go buy a public BDC, or if you wanted access to credit, you could go buy BKLN, like an open-end mutual fund. But to get access to private equity was always reserved for large institutional pension funds and investors because these were always in drawdown funds, and there's this J curve. And so for an individual investor who wants to make a big commitment to a private equity fund and have negative returns for the first couple of years and then lock their money up for 10 years, waiting for a dividend, that doesn't work for a lot of individual investors. So this product, Cascade Private Capital Fund, is in the interval fund structure. It's a 40 Act vehicle, it's a RIC, so we still have to pay out, we still pay out a dividend once a year. We offer semi-annual liquidity, so you can get your money out twice a year. It solves the J-curve problem. It solves the liquidity problem. And these investors haven't had access to a really high-quality private equity product. On top of that, private equity fees are really high. We, again, have brought another low-fee product to this universe. And the other beautiful thing about Cascade is it's taking the index-like approach. Just like CCLFX and SELF, we're giving the investor access to lower middle market, core middle market, upper middle market, mega deals. And then 30-40% of the portfolio is actually in secondaries, which is how we can deliver our dividends every year, and we can deliver liquidity, because when you're coming into secondaries, you can buy some of these assets at a nice discount. And there's been data that's come out that says, sometimes when GPs are putting their private equity assets into a continuation vehicle, that's still generating sometimes 20% plus returns on those assets. So they're putting their prize assets into these continuation vehicles. So sometimes we're coming into these and, individual investors don't have access to this type of information and these types of opportunities. So we're doing all this in a very index-like way. So if you're really heavy invested in equities and you're worried about like the Mag 7, which is driving how much of the S&P, and you're worried about everything being super overvalued, you tell me, Marianne. I was looking at the news today, the stock market's going up and up and up, and everyone's wondering, like, should it still be going up? So this is a nice way to diversify some of your public equity exposure, limit some of your downside risk, and get access to more parts of the economy through private equity.
Diversification really is so important in client portfolios. You talked a little bit about sectors. I thought maybe we could take a little bit more time and talk about the sectors that are in the funds, because they sound that they're a little bit more defensive. And when we have private conversations, one of the things that you always stress is it's very rare in the lending market to see negative returns. Why don't you talk about the diversification of the sectors being, I think, a little bit more defensive, and the return history?
Yeah, so within direct lending, we don't have to lend to everything. And the major difference between direct lending and the public loan and bond markets is we can't trade in and out of the debt. So if you're a CLO manager in the institutional market, you have to have a very diverse portfolio across many sectors. Those CLOs are built with concentration limits as opposed to how much you can have of certain sectors. So they're forced to do and lend to all different sectors. And the high yield bond market's very heavy energy names, leisure companies, like media companies, more cyclical companies. Direct lenders don't have to do that. And so because we're buying and holding these assets, we want to make sure that we can underwrite them through a downturn. We don't want to generate losses in direct lending. We want to try and mitigate our losses. So there's two ways that you can do that. First, you lend to more defensive sectors that are going to cycle better than more cyclical companies or more GDP type growing sectors. So software, healthcare, services, business services, financial services are kind of more of your defensive sectors. And then like your industrial companies might be more of your GDP grower. We're going to have some exposure to that, but you don't want more than 5 to 10% of that type of exposure. And then consumer could be a little bit more cyclical as well, or GDP grower. So you're going to have some of that in direct lending, but you don't see direct lenders going heavy into energy companies, casino companies, gaming companies, leisure companies, heavy commodity-based businesses, because those are going to cycle really hard. They're going to generate a lot of NAV volatility, and they're going to set you up for potentially high losses. And we're really trying to avoid that in direct lending. We're trying to give people sleep at night products
Quality,
that are high quality that we can weather. So if you think about, let's talk about, like, we lend a lot to these insurance broker roll-up companies. Whether you're in a really strong economy or you're in a weak economy, you need insurance. You need car insurance, you need homeowners insurance, companies need property and casualty insurance. So that's a defensive sector. It's not going to grow 10% a year in a downturn, but it's not going to be down 10, 15, 20% a year either. It's going to bump along 1 to 2%.
I call it the steady eddy.
Yeah, the steady eddy. So we're looking for companies like that we think can weather the downturn. And so don't get me wrong, there are losses in direct lending. It's very important to caveat. We see this in our direct lending index. we tell investors you should expect on average over long periods of time 75 to 100 basis points of losses per year. That is the average in our 20-year history of the CDLI. So there's some managers that outperform that, and they only have 10 basis points or 20 basis points. And those are the managers that we single out and we try to partner with within CCLFX and even in Self, right? We're trying to find the guys that have low losses. And then there's some managers that are delivering negative returns and have negative ROEs. And oftentimes we're finding those managers are reaching for yield and they have outsized position sizes. So they're lending to businesses and taking 5% position sizes on NAV. And this goes to your diversification question. The best thing you can do to mitigate risk in direct lending is keep position sizes small. Diversification, because you're gonna have losses. There's going to be issues that surface. For us in CCLFX, our average position size is 6 basis points. It's small. So we can have a lot of little problems and still be well under the loss rate in the index. And that's what we're selling. We're selling diversification and index-like returns.
So when we were having a conversation preparing for this, there was a line that you used, we stay rich, but we don't get rich.
Yeah.
I really like that. And so the profile of the investors, I guess, is a little bit older. People that just want that steady Eddie, good 9% return. Is that pretty much the profile of the client in your products?
Yeah. Well, we are very heavily working with RIAs because we do have minimums across RIA platforms. So Sanctuary is on our platform and any of your clients can come in and they don't have a minimum, but the RIA level has one. We want to make sure that there's no hot money coming in and out of our fund and we know who our clients are. So it's not like anyone can just go on, Schwab and Fidelity and buy this unless you're an RIA client and one of ours. So we do find that most of our clients have a financial advisor. So they have been working long enough to be able to develop a level of net worth that they want to grow. But to your point, we're not going to generate returns like NVIDIA. We're not crypto. We're not Bitcoin. We're trying to produce very steady, stable sleep at night products, compounded annual returns over long periods of time. We tell our investors, this is not the asset class that you buy in on Monday and you're exiting on Friday. Okay, that's a trade. This is not a trade. This is a long-term asset allocation in your portfolio. So we do tend to find that it's an older clientele that doesn't necessarily need the liquidity. If you're a young 20 or 30-year-old and you want to buy a house or you're getting married, you may not feel as super comfortable locking your money up for a quarter. But candidly, if you're okay taking a small part of your portfolio, putting it in one of our funds and just letting it grow, you're going to be really happy because, to your point, we really don't generate negative returns in the two credit funds. The equity return is a little bit more risky. You're taking more risk. That's generating 20% returns right now. And so if there's a huge market sell-off, you can see a drawdown in the private equity fund. It's not going to be as material as the public markets because it's more diversified. But the two private credit funds typically stay single-digit positive, even in down markets. So yes, it's for the person that's looking for the sleep at night product. They don't want to have to worry about losing money, and they just want that stable, compounded return that's going to grow over 4 or 5 years.
So with the growth in the industry, and I'm talking about the lending market, there's a lot of competition now. How is that impacting the industry?
Yeah, right now markets are really ripping. There's a lot of money coming into private credit in particular. We're seeing new entrants pop up every week. I will tell you that new entrants popping up in private credit is not new. If I think back 5, 10, 15, 20 years, this was a market built on more folks coming in because of the tailwinds and because of the growth. And so what we're finding is that these new entrants they're creating some positive dynamics, but they're also creating some negative dynamics. On a positive, the more players that you come into the market that are new, the more fees come down because all the assets start to be generating similar returns. Everyone's portfolios start to look similarly. It becomes more like beta. So it's really hard to justify charging high fees. So if we look at fees through time, they've come way down in direct lending and private credit, which is good for everybody because a fee cut is basically alpha, right? It increases your return if fees come down. So that's a positive. On the negative is, it is going to also impact terms and conditions and pricing. So that's another reason why we're seeing returns coming down from 12 to 9 is because of people driving those spreads down. There's been three prominent types of folks that we've seen coming into this market. The first is private equity shops that didn't have credit platforms are now launching credit platforms, because private equity, again, you're not always able to get your return so easily, but if you have very steady credit, you can generate a lot of fees for your institution. We're also seeing CLO managers in the public loan markets. They're watching their deal flow leave their market and come to our market, and they're saying, hey, I can launch a direct lending fund, or I can do an SMA. Why should I see all my relationships and all my deals leave my market and go to direct lending? I want to be in that market. So you're seeing a lot of announcements of CLO managers that are either acquiring small platforms in direct lending that don't have scale, that want scale, or they're poaching people from teams and hiring very senior level people to help build out their platform. And then the last player that we're seeing come in is the banks. You've seen big announcements from like JP Morgan, who's going very big in direct lending. They've even announced that they're coming out with ETFs, private credit and ETFs. Like Wells Fargo has partnerships with Centerbridge. And so there's a lot more banks that are trying to come up with partnerships with direct lenders. So it's like, hey, if you can't beat them, join them. Let's join hands. We can use the capital from direct lending, the origination funnel from the banks, and we can all win together. So there's a lot of that happening. So again, there's some good that comes from it, but it also does drive a lot of inflows into the asset class, and we have to be able to deploy that responsibly. There's going to be winners, there's going to be losers, and there's always a shakeout at some point in direct lending. And what you ultimately find is that the big players tend to absorb the weak players, and that's why the space actually continues to grow. And the bigger keeps getting bigger.
So it sounds low, based on everything we've talked about, we're not at that risk point yet. It sounds like we're still in the growth phase of the business.
Yeah, we're still in the growth phase. And I think what you're seeing is the smaller players that aren't diversifying their investor bases, they're not able to build a wealth platform for whatever reason, and they're not able to compete with the big asset managers that are growing. A lot of them are selling themselves to insurance companies or to some of these CLO managers in an effort to say, hey, I need more scale. I need more balance sheet. I need to be a part of a bigger platform so that if I'm by myself, I could keep the lights. Because if you're by yourself, keeping the lights on is a lot harder. So we're seeing consolidation and we're seeing everybody's kind of scaling up. I will say that the risk in direct lending has continued to decline through time. A lot of managers used to be small and concentrated, and now you see like BDCs have diversified capital structures and they're raising money in the bond market, not in the bank market. They have more flexibility. We're not using a lot of leverage in this market. Everyone's diversifying. So that's going to help mute any sort of huge issue like we may have seen 2009, 2010 when you had bank failures. You had small direct lenders failing and you had bigger managers sweeping them up. I think you're going to see less of that as we continue to scale. But so that's a good thing. It's becoming more high quality.
What are you seeing between the private part of the market and the syndicated part of the market?
Yeah, so there is this push-pull between these two markets competing with one another. 2-3 years ago, the public markets were shut. We were going through this dislocation with Silicon Valley Bank. People were worried about a recession. You saw that market shut down, and direct lenders were taking all the flow. Then we saw the markets open back up in 2024 and 2025. And all the critics and the skeptics were saying, oh, direct lenders, hope you enjoyed that year while it lasted. All your deals are going to leave. They're going to go back to the public markets, and they're going to get a cheaper execution. The truth is, Marianne, only a fraction of the managers and the deals did that. Most of the borrowers stayed in the direct lending market because they actually like the direct lending execution better. Even though it's more expensive, it's more flexible capital, it's more relationship oriented. And for investors that are in direct lending, the docs are better. You don't have the same downside volatility. You don't have the hot money that's coming in and coming out. And so it's just a more flexible market, and it's proven that sponsors and borrowers like it better. So now what we're seeing is there are direct lenders that can hold $500 million to $1 billion per deal. We are now getting opportunities to finance $5 to $7 billion deals every week. These deals are coming, and those used to be deals that only could get done in the syndicated market. Direct lenders used to finance deals up to $75 million max, $100 million of EBITDA max 5 years ago. Now we're regularly seeing $300 million EBITDA companies. And so for the syndicated market, that's a big reason why they're like, man, I need to have a direct lending pocket. I need to be in this market because their borrower set that they can lend to is shrinking.
No wonder the large banks want to get into the business.
100%.
So there's really a structural change that's happening, is I think what you're explaining.
Yes, because as these asset managers are scaling and they're raising more money and they're diversifying, they can hold more. So you don't need, the syndicated market was an amazing innovation from the 90s. And the CLO market generates 70% of the buyer base. It's like an $800 billion market, the CLO market. So they drive a material amount of the $1.3 trillion institutional loan market. But they're not flexible. If deals get downgraded or if deals start trading below 80 cents on the dollar, they can't really buy those assets. And so you see a lot of technicals going on in that market, which can be challenging. Direct lenders don't have that. They have workout capabilities. They can hold the borrower that loan through time. They have much tighter docs. So it's just a much better market. And the direct lenders have skin in the game. If they have a bad track record, they're not going to be able to raise money. So you have alignment in that market. Versus the syndicated market, you have the investment bank pitching to the borrower, hey, I'm going to get you the best deal possible. But hey, I'm not going to hold any of the paper. I'm just going to get the rating and I'm going to sell it down to CLOs. And then the CLO that bought your deal on Monday traded out of it by Thursday on the break. So it's like, there's no relationship there. So what happens is they have the doc loopholes are very loose. They use those to their advantage. And you have all sorts of things like liability management exercises you're reading in the news and poor recoveries because there's no one able to get the workout done. So we just think the alignment's so much better in the private credit market.
It certainly sounds that way to me.
Yes.
Based on what you just explained.
Yeah.
What are some of the risks that you're seeing or potential risks? Like what's on your radar?
Yeah, so definitely always worried about recession risk. You brought up, there was 1 year in history that we saw in the index where the returns were negative. I'm not going to say that during a recession returns are going to be amazing. There is pressure on returns in a downturn. So 2008 was the 1 year that we saw negative returns in direct lending.
It was very unusual.
Very unusual. It was a 3 sigma event. I think it was like negative 8% for the year. However, the public loan markets were down 30%. High yield bonds were down 25%, and equities were probably down even worse. So even if we go into a recession in private credit, we're going to be down, but we're not going to be nearly as down as all the liquid markets are. So that's one thing. And then during COVID, that was the other potential downturn situation. We've definitely recovered quicker from it, but I think returns in the index were around 5% for the year. So they weren't that high single digit. So obviously recession is a risk. It's going to hurt returns because losses do pick up and you do have to mark the assets down. So that's always the risk. But again, I'd rather be generating a 3 than generating a negative 30. The other risk to direct lending is, we talked about the new entrants coming in. If you're picking managers, if it's becoming harder for investors to pick the right manager because the returns all look similar right now in a solid market. If you start going through their portfolios, you see a lot of overlap. They start to look and smell the same. It takes a very sophisticated investor to go through their portfolios to really get a sense of who's a premier lender, who's getting the top phone calls, who's getting all the reverse inquiry. There are some key players that have big incumbent portfolios and they can make really good credit decisions in competitive markets. Then there's a whole host of players that can't. They're in weak market positions and they're either reaching for yield or they're forced to do deals that are not high quality that are probably going to cycle badly. This is another reason why people really like Cliffwater's products, because we are so sophisticated and partnering with all these managers across our fund. So CCLFX partners with 15 to 20 different managers. We're on pipeline calls with them every week. We see all the deals in their funnel. We can pick out which managers are really strong and which really managers are struggling and that are weak. And we want to ensure that our investors are getting access to the best managers and the best deals. So for folks that are looking at buying public BDCs, like, you really have to be able to go through their portfolios, understand the assets, because they do kind of look the same in a good market, but in a down market, that's where you start to see dispersion. So when we have a downturn, it's going to be interesting to see, who performs well and who doesn't.
It does sound like you have a competitive advantage because you created that Cliffwater index.
Yes.
Yeah, so I just want to point out, I think they have a little bit of a competitive edge and they've created some really great relationships.
I love the index because it's just so interesting. You have to be able to report. Those managers have to report. And there's so much analysis you can do, and it goes back 20 years. So Cliffwater Direct Lending Index is the oldest index that's out there. There's other folks that are trying to launch indices, and there's a lot of folks that cover BDCs now, but we were the first. We've been doing it for 10 years. It goes back to 2004. We're the only index that goes back through 3 down cycles: the GFC, the 2016 oil crisis, and COVID. So it really does help you get a comfort with the asset class.
You are the blue chip. You heard it first. I'm calling you the blue chip of the credit lending. This has just been a fabulous conversation. So we're coming to the end of the podcast. So we've talked about so many different things. What haven't we talked about that you think is important for our viewers and our listeners?
Yeah, I mean, I think we did cover a lot. I guess what I will just say is that the markets are competitive. And our goal with all 3 of our interval funds is we're not just out there building products for the sake of building products. We've been very careful about building products that we think solve a need for an investor. And so we believe strongly that when we look at these markets, we've been following research on all of these markets for 20 years, that when we carefully constructed each of these funds, that we were trying to solve a problem. In direct lending right now, it's a supply constrained environment. You're hearing about, there hasn't been enough deals, this or that. We solved that problem by building it as a multi-manager fund. When we built Self, we wanted to find areas outside of direct lending that had downside protection. That fund's very heavy ABF. And so even though it's generating more return alpha relative to CCLFX and it's taking a little bit more risk, it has a lot of downside protection because it's backed by hard assets and collateral. So I guess what I would tell the viewers are, the markets are really competitive. Alternatives can be a little bit confusing. We really tried to make sure that we used our research. We're using our entire investment team to make sure that we're giving you diversification, index-like products, so that no matter what's going on in the market, we can pivot. If the large part of the market's really competitive, or if deal flow dries up, we can pivot to the core of the market. We can pivot to the middle market, the lower. So we've built it so that we can just pull levers and find the best deals for our investors. And that's really our competitive edge, because if you're a single manager, you really can't do that. If you only play in big deals, it's really hard for you to pivot down and do small deals. That would take you years to build that out. We can pivot very fast, and we've built the fund to ensure that we get access to everything. So we believe very strongly in our products, and we hope our clients are very happy using them.
Well, I have learned a tremendous amount. Even though this is our 3rd, I'm continuing to learn. I can't thank you enough, Fran.
Thank you for having me and for listening to me for a 3rd time.
No, I love it. And what you're doing at the firm just sounds fabulous, and really delivering a blue chip product for solutions for our advisors and for their clients. So thank you so very much.
Thank you.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.